Hello everybody, here is again another exercise case in combination with cross-border deliveries and cross-border transactions. It's already now exercise case number 16, and here is what happens. A from Aachen sells a production machine to B from Brazil for 200,000 euro. That is the amount, the official price, so that is clearly the amount which has to be paid under the contract. And B from Brazil in turn sells the same machine to C from Chile for 250,000 euro. The conditions in the contract for C or demand that A is obliged to bring the machine to Hamburg, and there an employee of the final customer C from Chile is going to take it over and do the rest of the transport to Chile. After a while, C sends the customs documents to A because B asked for it, or A, as a proof for the exportation. How is the situation correctly treated under German VAT law? Well, let us begin at the beginning, and the beginning is usually an analysis of the situation. So what happens here? We have, first to look to who has a contract with whom. We have A from Aachen, who is a contract partner of B in Brazil. What happens is a machine is sold for 200,000 euro. There is additionally B from Brazil, who has a contract with C from Chile, and the machine is sold for 250,000. So now we know what happens. Now you remember perhaps some basic rule. If one and the same good is sold twice, then there must be a sequence with regard to time. There must be one contract fulfilled first, and only then the second one can happen, because you can't give away a machine before you got it. So there is a clear logical sequence. A must first deliver to B, only afterwards B can deliver to C. That's already nice. Now we have to look where each delivery begins and ends. So let's look to the people to do a part of the transport here. A does a bit of the transport. That is evidently when A drives the machine somewhere. This is evidently A fulfilling his contract. Now you also have C doing a bit of the transport. And that can only mean that C does transport his acquired goods to the place where he needs them. So the transport made by C belongs logically to contract number 2. This transport by the employee of C begins in Hamburg and ends in Chile. Logically, that means when transport number 2 has already begun in Hamburg, then transport number 1 must begin in Aachen, where the machine is in the first place. But it must have ended in Hamburg, because in Hamburg already transport number 2 begins. So that is now what happens here. A clear analysis of the situation shows the machine is first sold from Aachen to Hamburg, from A to B, and then the second transaction shows the machine goes from Hamburg to Chile. Evidently, our friends here got it wrong, because A demanded the exportation proofs, but A will not be able to use them. During the first transaction, that machine did not leave the country. That was an interstate or intrastate delivery, no exportation. So after we see that clearly, that situation, we can naturally then go on and begin with our solution. Transaction A, from A to B, movement of the good from Aachen to Hamburg. We have first to test taxability, paragraph 1.1, number 1. Well, the acting guy is an entrepreneur. Yes, we can assume that for A. Private persons don't sell production machines for 200,000 euro to others. That would be extremely surprising. Within the scope of his enterprise, yes, evidently, presumably, we can say if somebody sells a production machine, that is either his core business, if it's a machine factory, or it's an ancillary transaction if the machine has served his enterprise before and now he sells it secondhand. This is at least one of the events which in the course of time happens in his enterprise from time to time. So it has a connection with his enterprise, even if it's a less important one, so it is within the scope of the enterprise activities. Yes, definitively. Is it for consideration? Yes, he demands a price, and that's everything which we need. So let's come to the really important stuff. Is it a delivery? Yes. 3.1 USDG says, yes, it's a delivery because the machine is a tangible good. And additionally, the fulfillment of a sales contract, handing over the machine, is a transfer of a position like an owner. So it's a delivery. Does it happen in the inlet? You remember, that has nothing to do with what is really going on. This is a completely artificial criterion where the law decides, do I want to apply my legal rules to that transaction or not? If they want to apply it, they say it happens in the inlet. If they don't want to apply it, then they just say completely by fiction, it does not happen in the inlet. The basic rule here is the same as always. The place of delivery, if the good is moved during the delivery, where the movement of the good towards the customer begins, that is here in Aachen, that is in the inland, and that it means the whole transaction is taxable. Now we go on. After step number 1, step number 2 follows. Do we have an exemption? And we have to test paragraph 4, especially is that an export or exportation, or whichever word you prefer, to a third country. We have to see paragraph 6.1. In paragraph 6.1, in all the numbers which you find there, requires that during the transaction, the good crosses the border and leaves the country. And as you see here from the sketch of the situation, during transaction number 1, the good begins to be in Aachen and ends up still in Hamburg. Both is within Germany. So the good does not go to a third country during this transaction, but only during a later transaction. That is not what is sufficient. So this transaction is fully liable to tax because the good does not leave the country during this transaction. So the tax base has to be found now. Next, it's the net amount. That is defined as everything which the entrepreneur gets, so the gross amount, 200,000, minus the value-added tax amount included therein, and if there is a VAT amount included therein, and if it's 19%, we can deduct 19 out of 119% of 200,000, that is 31,932.77 euro. And we end up with a net amount of 168,067.23. The tax rate and tax is 19%, so the tax is 19% of 160,067.23, so 31,932.77. And now imagine if A genuinely expected that 200,000 would be tax-free, and that was settled as a price without a clause that 200,000 is meant as the net amount. This error of an accountant that the transaction would be tax-free, but it isn't, would cost the firm 31,000, because that goes now to the fisc, and if the contract does not allow you to add the VAT to the price, this is an enormous failure, something which the Germans call a shot into the oven. So let's just go to the final remarks, the formalities. The taxpayer responsible is the entrepreneur who does the transaction. In our case, that's A. So he can't shift that under the legal rules. If there is not in the contract a rule, I can increase my price by VAT, then he has to bear the tax burden. The arisal of the tax, by the way, every clever accountant who is familiar with situations like these, every clever negotiator in a business-to-business relation will always negotiate a price as a net price and add a clause plus the VAT, which is due, can be added to that price to keep the VAT situation in an open way. So if VAT happens to happen, then you can add it on the price and the recipient can the customer can demand it back. But here something unpleasant happened, you did it wrongly, and so you end up with a tax burden. The arisal of the tax is at the end of that preliminary declaration period. You remember that is usually the month during which the delivery is made, and here is no date given, so we can't determine that. The invoice must be completely regular. That means that the seller must confirm the correct VAT amount in the price so that the customer B can claim it back as input tax. Declaration duties are the same as always, nothing special there. And peculiarities, well, it might be that A believed the transaction was tax-free and did not include VAT in the invoice for that reason. Then he has to adjust his tax declaration in the moment when he realized his mistake. And also B has a claim to get the invoice corrected because paragraph 14 subparagraph 2 says that a business customer always has a right to an invoice confirming the VAT amount included in the price so that he or she can demand the money back. Input tax claims, B is an entrepreneur and has for that reason a right to get the input tax VAT refunded under 15.1 number 1 USDG because he is an enterprise owner and bought the machine for entrepreneurial purposes. As he is not resident in the EU, it can be that under certain circumstances, due to special legislation, that right is restricted to cases where Brazil also grants a VAT refund retrospectively in corresponding similar cases to people from the EU. But in principle, there is an input tax refund claim. Now, let us go on to the next part. Transaction number 2 is B sells the machine to C. Here, the good goes from Hamburg to Chile, and so we begin with taxability again. We need to check 1.1 number 1, not 1.1 number 5, that's clear. So the same as always, B is an entrepreneur, acts within the scope of his enterprise, and for consideration, that seems relatively clear. Is it a delivery? And the answer is yes. We have the transfer of economic ownership, and the machine is a tangible good. So what I forgot here is to write down yes, 3 subparagraph 1 USDG confirms that that is a delivery. Next question, did it happen in the inland, or is this delivery attributed by the law to the inland, to put it more clearly? And we need to check the rules on the place of delivery for that reason. The same rule as always, we have a delivery combined with the movement of the good, a transferred 3.6 sentence 1 USDG, where the movement of the good towards this customer begins, that is Hamburg, that's in the inland, and so the transaction is still taxable in Germany. Is there any exemption from the tax? Paragraph 4 is the list of exemptions which we have to check. What comes into consideration is it an export or exportation, you know, however you call it. And C here brings the good across the border, so the customer. That is the case of 6.1 number 2. 6.1 number 2 USDG says something is a tax-free export if the customer brings the good across the border into the third country and the customer is a foreign customer, a customer from abroad. Now, what is a customer from abroad must be regulated by legal rules. So you find out indeed that a customer from Chile is under the legal rules of 6.2 USDG, a foreign customer. So we have an export. An export is then tax-free under 4 number 1 letter A of the Umsatzsteuergesetz. However, in our peculiar situation, there is one slight problem. Customer C has, according to my case description, handed over the exploitation proofs not to B but to A. Now A can't use them because A didn't, make an export. So it might be that B has not got the exploitation proofs. That would mean, consequently, that for B it's not feasible to prove the exploitation. In such a case, a brutal logic would apply. If there is an exemption, it has to be proven. If there is no proof, it is unproven. If it's unproven, it does not exist. So if it does not exist, the exemption, then the transaction would be fully liable to tax. Until the necessary proofs show up, then you can correct your tax declaration. So in that case, if the exemption can be proven, the tax base, all what is paid, would be 250 minus the VAT of 0 included in it, because then there is no tax included. However, if the situation is otherwise, if A still has the exploitation documents, nobody handed it over to B, then B is in the bad situation that he made an export but can't prove it. In that case, B's 250,000 would be a gross amount until the proofs can be obtained. The tax base would then be 210,840. The tax would have to be computed next. I forgot this here on the slide, sorry. So as you see here, between 3 and 5, probably basic school is a long time ago, or I got bored by the own case. Happens. Well, so you would have to include that number 4 is the tax, and the tax rate and the tax amount, 19% under 12.1, and compute the tax. However, then we come to the formal aspects. You know that a keyword paid, P for taxpayer, A for arisal of the tax, E or I for invoice, and D for declaration duties. The taxpayer is the entrepreneur, and in our case that is B, because here B sells. The arisal of the tax is at the end of the preliminary declaration period. You remember that's mostly the months during which the delivery was made. See paragraph 13. And the date is not given here, so we can't determine it more clearly. The invoice must be net because it's a tax-free amount, and it must have a remark why it is tax-free. So a remark it's tax-free because it's an export. The declaration duties must be fulfilled in Germany by B, the deliverer. So he must hand in a tax declaration in Germany so that the tax administration can check if the export is really tax-free, so if the proofs can be given. Any special aspects? None are present. The input, however, there might be one. For example, if it comes out, well, we don't have the proofs for the export, they are in the hands of A, then you could ask A for handing over the documents, and if A handed over the documents, then B could prove the export and then could correct the tax declaration and get the VAT payment back. Because from the moment on when an exportation, when a tax exemption is proven, then you need no longer to pay the tax, and if you already paid it, you have a claim to get it back if that is still within the deadlines set by the general assessment rules, which are laid down in Germany in the so-called Abgabenordnung, so in the general framework for taxes, the general tax code. But in principle, you can try to correct your tax declaration and get that excessive money back. Input tax refund claims would exist for B. B bought the machine with VAT burden, and he has an input tax refund claim for the transaction A to B, in spite of the fact that his own delivery is tax-free, because if you make an export, then in spite of the fact that your own transaction is tax-free, you still keep the right to input tax for all the input. That is a special rule in 15.3, number 1 USDG. If B believed that the transaction were taxable and liable to tax, or that we don't have a proof, then C would nevertheless not be entitled to input tax refund even if B paid the tax in full, because if you have an export or an intra-community delivery which could have been treated as tax-free successfully, then there is no input tax refund possible. Then the way which is correct is that the deliverer has to correct the tax declaration, has to claim the tax exemption and write out a net invoice. So you can only demand tax exemption here. Well, that was everything I had to say to that small little example. I hope you had some small or huge insights from it. If neither nor, then be happy that it's over. Then concentrate on how the case has been approached. So, for example, with that first analysis, what happens at all? Because the people here involved in the case, A, B, and C, evidently thought, well, A sells something and finally it's end up in Chile, so it must be an exportation, and that was horribly wrong. So have a look to how we dealt with that case and learn from that. Okay, thank you for your patience in watching this small little exercise case, and would like to see you soon back on this channel. Until then, recover well, press the like button if you want to, recommend the channel to others, and all that, what one usually does on YouTube. Thanks for watching. Goodbye till next time.